guest turned his passion for motocross into starting the leading sports sponsorship platform, Hookit.
We ultimately got acquired in January of 2022. It was a 20-year overnight success. We did end up getting acquired for almost double what the original offer was. So we've ultimately decided to take 100% of the proceeds out. Every founder that I know that has done earnouts and things never works out the way that you're hoping. The only thing I maybe would have done differently would have spent more time during the process of how are these two things coming together? What does kind of the vision for the combined entity look like? Those were things that never really got looked at or discussed, and it honestly never really got sorted out, and it still isn't sorted out.
Rarely done.
Yeah.
And even if you do talk about it, sometimes it just still doesn't matter, right?
Yeah.
You're going to face the reality when the two companies merge anyway, and they're going to do what they want to do. Welcome to the latest episode of High Stakes. I'm Paige Soya, the managing partner of K Street Capital, and today we have Scott Tilton. So before we get into some of his exit experiences, Scott, why don't you go ahead and introduce yourself?
So I'm Scott Tilton. I'm the one of the co-founders and former CEO of a company called Hookit. We were a data and analytics provider, very much in the SaaS space, where we worked with global brands on helping them quantify sponsorship impact by tracking their athlete, team, and league deals across social media. It was a pretty innovative concept at the time, and it ended up being a 20-year journey with a couple of pivots along the way. We ultimately got acquired in January of 2022. So it was a 20-year overnight success, as some folks call it here in San Diego.
Yeah. And you're still with the the original company, but the buyer.
Yeah.
Today, right?
So I stayed on full time for about 15 months, and then I left last May for my day-to-day responsibilities. But I've still been active on the board and working with the management team and the other board members on really just business strategy and ensuring that the company continues to grow and is successful. And so it's been a very different role than what I had played over the 20 years and then the 15 months after the acquisition. But and it's nice because I, kind of show up once a month for financial calls and quarterly board meetings. And so I'm still pretty involved in the business, but I just am not getting my hands dirty that much these days.
So are you thinking about what you'll be doing next?
Yeah, it's been coming up a bit more. I'm starting to get a little antsy. I've had almost a year and a half off, and I've been helping consult and just advise a couple of startup companies here in San Diego and a couple of companies in the space. But I haven't really kind of dug too deep back into anything yet. And my business partner and I, we've been dabbling with a lifestyle brand that we've always wanted to kind of focus on. And so we've been doing that part-time. And but I would say probably by January, I'll get back into something. I'm not quite ready to hang up the...
You kind of need a break.
Yeah, but the break has been great. I've got 3 young kids, and so being able to spend time with them at a kind of a critical time has been really nice. And but I've definitely realized that I need to work. It's otherwise you kind of get bored. You can only play so much tennis and go to the gym.
That's fun for a while, but I think a lot of founders, me, I'm in the same boat. It's like you try to do something, you crush at something for a really long time, nonstop, and then you sell it, and you kind of have like this period of almost recreating yourself and starting from scratch and taking a breath, and then just going back out and doing it again, basically with something different.
Yeah. Yeah. So I haven't landed on anything specific yet, but the interesting thing, though, was kind of personally when you finally get to pick your head up and you're not in the weeds of something that you're so passionate about for so long. There's so many cool things going on out there and things that you never even thought of. So I think that's been kind of the more interesting side of it, is looking at what else is going on out there and where can you kind of apply your experience and background and your strengths and apply it to something completely new that will be a new challenge and something that that you can really get behind. So that's kind of where I'm at right now, is like, what new path do I want to pick, and what do I think I can be good at as well? Because it's once you kind of have a taste of being successful, you don't want to fail at something trying to start over in your mid to late 40s.
Yep. It makes sense. Cool. Well, I'm excited to hear what you end up doing later on. Maybe that's another episode.
Yeah.
But going back to the exit, and I know you said it was January of 2022. I think we all know what that environment was like, but maybe you can talk a little bit about what it was like at that time going through a transaction.
Yeah, maybe if it's helpful, I can kind of go back a little bit and talk about the journey to lead to the exit. We almost sold the company in 2012, and when we originally started the business, and this was way back in the early 2000s, it was more of a networking platform similar to LinkedIn that operated as a way for athletes to connect with sponsors. So athletes could come on and build profiles, and then brands were using it as a CRM tool, and they could administer all of their athlete applicants and who they gave deals to and all of that. So we started to pivot the business model in 2012 and 2013, where we realized we developed this score. It was almost a credit score for an athlete to help score and rank them for brands so that they didn't have to sift through thousands of applicants. It could help automate it a little bit more effectively based on the athlete's performance and reach, which was their exposure and how much impact they generated on social media. So that score is really... when we didn't sell the company in 2012, we took a step back, and I had this opportunity to meet with Vinod Khosla out in Park City. It was literally on December 26th, I think. It was like the day after Christmas, and it was at his house, and I took him through the story of kind of how we built the company, and he very quickly, in probably the span of 30 to 60 seconds, it's like, yeah, that business model isn't super interesting. I don't see a lot of scale in it, and but tell me more about this score that you built. And he's like, that's super interesting. And what the score did was it was an automated way to ingest all these event results and competitive data. And then the social media was the athletes were connecting their social profiles, and then we could track how many followers they had, how much engagement they were generating. And he just said, that's super interesting. And how are you monetizing that? And I just told him that we didn't start yet. It was more as a way to help the other business model work. And he's like, your only takeaway should be, how can you use that data and revolutionize the way that your industry operates? And I was sitting on the plane on the way home, and I was like, holy crap, we can quantify sponsorship value from social. No one's doing that. Everybody's talking about how many followers they have, but no one is really digging into what that means for a brand. So we spent the next probably 6 to 9 months building out this, what we call the sport graph. And instead of tracking the athletes that were on Hookit, we started tracking every athlete, team, and league across the universe of sport, and tracking how many, like what they were doing on social. And then we took it a step further, where beyond just measuring followers and engagement, we started analyzing the content and understanding how these folks were promoting brands. And then we ultimately started putting media values against it based on how much engagement that the posts were getting. So that was really kind of the beginning of this whole pivot into data and analytics. And everybody was looking at like Nielsen and print media and some forms of digital media based on impressions, but no one was really effectively tracking social media and what these athletes and teams and leagues were doing. So we were really the first to do that, and the platform that we built was super innovative, and it was all real time, and brands just started to clamor to it, because social, especially in more of the fringe sports, when you get into sports like surfing and motocross, and some of these athletes have huge followings, and the TV media platform isn't there for some of those sports, but the brands are all still heavily invested in it, and social media was really the only way they were activating. So we did that for a couple of years, and
this was 2012, right? You're saying
it took 2012 was the kind of the time when we realized that we needed to pivot, and we saw this opportunity, and then we just started to focus everything on it. And the old business model was still up and running and helping fund kind of the development of all this. And but we were stuck at 1.5 to 2 million in revenue for probably 10 years. We just couldn't break through, because with that older business model, we realized that there was a life cycle to an athlete. So we'd have this huge turnover every 3 to 4 years, where athletes got competitive in sports, and then there's a natural fall off that you get hurt, you just lose interest, you go to college, whatever it is. So we just were kind of recycling the same business every 3 to 4 years, and we never really broke 2 million in revenue. But when we when we did implement the data and analytics piece, and it did take a couple of years to get it refined because we weren't really well funded at the time. It was all self-funded from the proceeds of the business. It took until like really 2015, 2016 till we started getting some traction with brands. And GoPro was our very first customer on it. They were local here. We had some of their sports marketing guys had used to work for us. And so they were kind of our pilot brand that we launched this with. And they were huge in social. And they had, hundreds of athletes that, all were focused on social. So we really kind of built it and tested it with them. And then Toyota came on and we started working with them on their sports marketing activations. So at the end of 2016 was when I met Matt from Arrowroot Capital, and they were much later stage investors. They're kind of in between VC and PE. They kind of consider themselves more growth equity. And at the time, they had specific requirements of, 5 million in revenue, profitable. We were neither of those two things. And he almost did a deal with us at the end of 2016, but then he, took a step back and said, in talking with the partners, like, we need you to be further along and really prove this out. So we gave him our forecast for 2017, and he said, okay, well, we think that you'll maybe achieve what you say you're going to achieve in March by September. So let's just stay in touch. And he didn't really believe the model fully. So we ended up, just going heads down, and we secured a bunch of brand partnerships, and we ended up hitting our May number by March. And I called him up, and we immediately got into diligence, and the diligence went super quick for this raise. And I think we were done with diligence by May, but then it took about 2 months to get through legal. So, and the thing that probably took the longest was our employment agreements, because it was a big raise. We were giving up control of the company because we wanted to, we ended up raising 16 million in that raise. But half of it was to buy out all of our existing investors, and the other half was for growth. So we were giving up control, and so we were very concerned about kind of our roles and what would happen if things didn't go well, because we didn't really know each other that well yet, and it's always a risk with new investors. And so we navigated through all of that, and then we were on a good trajectory. I mean, we grew from 25 employees to about 100 employees over the following 18 months, and we were on a good clip. And then 2020 hits, and we were very concerned because I was at the MIT Sloan conference, which is their big sports analytics conference. And it was the day before I was flying home, and this was literally a week before COVID kind of hit. And Matt called me and said, hey, did you see that Sequoia report and kind of what all their portfolio companies are doing about COVID? And I was like, honestly, I haven't even really looked into it yet. I just got done speaking at this conference. And so he's like, I'm emailing it to you right now. Just read it on the plane. And so I read it, and I was like, oh, wow, like this could be bad. And then
no sports.
Yeah, for sports. And so it was literally 4 days later that the NBA shut down their season. Then 2 days later, F1 postponed their season. So like everything in sport was shutting down. So we definitely got very nervous. And my management team and we kind of locked ourselves in a room between Thursday and Sunday. And on Monday, we cut about 35% of our staff. And all non-essential spending, and we wanted to do it fast and early because we wanted to take care of our team. So we gave everyone, I think we ended up giving people like 4 months of severance to try and, sort out what they were going to do next. And the worst part was that we had to do it all over Zoom, because at that point everything was shut down. So.
Well, actually, I want to go back to that timeline for a second, because we had so many companies that we talked to that just weren't ready to face the reality of COVID for too long, of course, and that really hurt them in the long run. But it sounds like, what was the time period? Like the NBA shut down, and
this was on Wednesday, and 5 days later we made all the changes and cuts. So
what is this, February of 2020?
No, I think it was like the first week in March, maybe.
Yeah,
It was
that was early.
yeah. It was, but so the reason we did that was, so RJ Kraus is my business partner, and we started the company together. In 2008, we almost lost the company, because we were younger, we were pretty naive, and, we had just moved into this big space anticipating that we were going to do a big raise. And, then the market just tanked. We couldn't raise capital, and we were paying a ton of money for rent. And, I remember, we couldn't make payroll the next week, and we couldn't pay our rent, and it just got really bad. And then, the bank drew a line of credit because we defaulted on our lease, and we had to negotiate terms with them to pay that off over 3 years. And so we had been through that. And when COVID hit, that was just ingrained in us that we were never doing that again, and we were going to be smart and act really quick. So that was kind of the rationale, and we just cut hard and fast and made sure that we were at break even and we could fund the business. So it ended up being a blessing in disguise, because we ended 2020 flat, and then we were up about 40% in 2021.
Wow, on a top line basis?
Yeah, on a top line basis, yeah. So
basis, yeah. Okay.
So I think it's probably important that we kind of talk about the strategy that we put in place during COVID in 2021. That is the reason we got acquired. So at the end of 2019, we were pretty evenly split. Our customer base was brands, and then we had a lot of team and league clients. And we were doing all this analysis in 2019 and quickly realized that, teams and leagues don't pay as much. They're a lot harder to service because they're more demanding. Brands paid us about 3 times more and were way more strategic and thoughtful with how they used our data, and were easier to service because they looked at us as a strategic partner, not a vendor.
Right.
So we were helping them make more informed sponsorship decisions. So we tried to make a pivot in 2019 where we were going to be more focused on brands and teams and leagues. And it was actually really hard. Our CRO wasn't fully on board with the strategy. Half the sales team wasn't really on board with the strategy. So we ended up making a decision in December. I just basically pulled the Band-Aid off, and I said, if whatever teams and leagues are in the pipeline, if they don't close by December, we're not talking to them again. And we were going to be 100% brand focused in January of 2020. And some of the sales guys weren't on board with it, so we let them go. And then COVID hits, and our CRO is still struggling with it. And we're having all these churn issues with teams and leagues because events are shut down. And she kept taking her eye off the ball on what are we doing to go after brands during COVID, because they need us right now. So we parted ways in June of 2020, and I took over the sales team. And at that point we were down to 4 salespeople, I think. And it was a challenge because no brands were really doing anything because they weren't authorized to sign new contracts. No one knew what was going on.
It's a standstill.
Yeah. So we put almost a bet the farm strategy in place where we were going to give our data to brands for free, and but they were still going to sign contracts with us where we were going to give them data for 3 to 6 months at no cost. But then once that period was up, then the contracts converted into revenue paying contracts. And and to make it even more enticing, we gave them an out. So at the end of the 3 or 6 months,
they didn't even have to convert.
They wouldn't have to convert. And so we just went heads down, and our whole motto at the time was, we want to be supportive and helpful, and we want to be an extension of your team during these times that are so unknown. And with no events going on, really the only thing left was social media at the time for them to track. And if brands weren't concerned about measurement and ROI, COVID forced that. So it created a really interesting tailwind for us. So, fast forward to the end of the year, we signed about 25 new brands that year. And
go ahead. Sorry, I want to ask you something.
Yeah, go ahead.
Well, I was just going to say, I think we talked about this before, but I want to ask you again because I thought it was a good answer. What made you decide to go through with that bet the farm strategy? Because that's, like you said, very hard to do. Yeah. Has a lot of pains along with it. But why did you decide to do it? And Arrowroot was your investor at that time also, right? So they'd been with you for a little while.
Yeah.
And how did you get them on board with supporting the pivot?
So they were actually very interested in it. And when they were part of the analysis in 2019, because they had really good analysts and we were going through the data and the revenue and all the financials. And it got to a point where they're like, why do we even service teams and leagues? Like some of these clients are like break-even clients because what they're paying us and the effort from a customer success standpoint, and we had a lot of data processing costs. Excuse me. So they were asking, like, why are we even servicing some of these clients because of the time it takes to service them and then our processing costs. Like, it's literally some clients we were losing money on. So they were on board with it. And then when they looked at the brand side, they're paying a lot more, they're easier to service and support, and they're way more strategic with how they're using the data. So, like, why don't we just do a lot more of that? And it's easier said than done.
I mean, it makes sense.
Yeah.
But they also trusted you in that decision, I think, a lot, probably.
Yeah. They definitely did. And, but the challenge with the pivot is that it's hard because selling brands is very different than selling teams and leagues, and getting to the brands is a lot harder, because they're not out in the public eye, like at conferences, and they're not bouncing around because everybody wants something from them. So, getting to brands is a lot trickier, which is why the sales team didn't want to really focus on it because it was easier to get meetings with teams and leagues. And, so this strategy ended up working really well, and we signed 25 brands, but no revenue was really hitting in 2020. Like, a couple of them converted, but most of them we kept giving them a little bit more time, and said, okay, we'll just convert them on January 1st. So while all this was going on, we did do a soft process to see, like, are there any interested buyers? Because we didn't want to raise any more capital. We were doing pretty well. And so we had 4 people kind of show interest in it. And while we were, going through the process, pretty much every offer was a super low ball offer, and it was about the same or less than what we had even raised. So I think everyone assumed that we were in distress, and as we were explaining the strategy that we put in place, they're like, well, it's not proven yet. There's no, like, none of the revenue is hit. Who's to say that any of these are going to convert? So we just agreed to part ways and just put our heads down again and just kept executing the strategy. And sure enough, of the 25 brands, 24 converted between like December and January. So our MRR just popped immediately. And then we just continued executing that strategy for the first half of 2021. And we added, I think, 35 more brands in the first half of 2021.
Wow.
So it completely flip-flopped our revenue to high-quality brand revenue, profitable, and it just put us on a completely different trajectory.
So we sort of know the end of this story in the sense that, I know we're getting there, but the exit actually happened in January of 2022, and it was successful, and that's great. But at this point in time in the story, if you had a buyer, like someone who was willing to do it, who was willing to make that bet at that moment, I guess I'm wondering if you would have taken it, and how much less would you have sold for in that moment, Yeah, so interestingly enough, who ended up acquiring us, so Core, they were one of the 4 in December of 2019. And as luck would have it, I spoke on a panel with their COO in July of 2021, and he asked for an update, and he's just like, oh shit, like, it worked, and because they were all skeptical of how we were approaching it, and it was like a little bit of a wing and a prayer. Uncertainty in a very uncertain time for investors.
Yeah.
I remember.
Yeah. So he immediately reconnected me with the PE firm that backed Core, and we started having conversations at the end of July, early August, and they're just like, wow, okay, it actually did work, and you guys have made a ton of progress since we last talked. And so we had an LOI by September, and then we started diligence in October, and then we were done with diligence in early November, and then we started legal. And then again, legal took, 2 of the 3 months. But it was a very quick close because when we decided that we were going to go down this path. Like, we didn't open it up to anybody else. We just knew that Core was the right partner for the business, and there was a lot of synergies between what they did and what we did, and there wasn't much overlap in the customer base. So it was kind of a mutual value add for the two businesses. And so we never even talked to anybody else again. We just went all in with Core, and they knew that. So we were very committed to making something happen. And if it happened, great. And if it didn't, great. But the process went so quick. It was like literally 30 days of diligence, 2 months of legal, and we signed on New Year's Eve, and then we closed in January.
That's awesome. Well, congrats again. That's such an incredible story, and I know there's more to come from it. But and I think we've talked about this, but I know legal is part of it. But going through that exit, because that at the time, that was your first exit as a founder.
Yep.
After a 20-year journey with a lot of ups and downs. And I'm wondering what went as you expected in that transaction process, and what didn't go as you expected, like the legal, or maybe you were expecting the legal to be slow given the last.
Yep. It's you always have to look back at kind of the experiences that you went through. And when we did our initial raise with Arrowroot in 2017, it was almost identical. So we had been through that process where we had just a phenomenal CFO who was also our COO, just super organized. And when we got into the process with Arrowroot, we set up a data room, and between myself and the CFO, like, we were so organized that we had everything that you could possibly think of in this data room, so that when we started the process, we were so organized that the diligence piece always went quick. And so it only took a month of diligence when we did our raise in 2017. It took a month when we were selling the company, because everything was ready to go. We were organized, and we weren't hiding anything. Like, it was just like, here it is, like, have at it. And then it took 2 months of legal in 2017, and it took again 2 months when we were selling the company. And the differences between the two was, it took almost 2 months to get our employment agreements figured out in 2017. Like, that's where the biggest hangup was. Because at the time, like I said, we didn't know Arrowroot very well. They turned out to be just an awesome, like, investment partner. They were so good to us as founders of the company. They always did what they said. But we didn't know that when we were doing the deal in 2017. Right. In my employment agreement, it was really important that we had a good board structure, so that we weren't giving up control of the board. And then I also had protections in place so that they couldn't just sell the company a year later because they were the majority owner. So they agreed to the board structure. They agreed I had blocking rights for, I think, 4 years. So I figured that was enough time to be able to execute, and I either was going to do it or not. And I was okay with that. But that all worked out well. But when we were selling the company, legal was a completely different set of challenges. It was more around, like, tax codes and who was liable, and lockup periods because Arrowroot ended up rolling over some of their investment. And so it was a much different type of legal issues that were being debated.
Okay.
And but then at the very end, so we signed the docs, but my employment agreement wasn't, like, even looked at or talked about yet. So myself and RJ. So we spent the entire month of January, like, going back and forth on the employment agreement again, and what the comp package looked like for post sale. And it literally held up the close, because they're like, oh, we'll figure it out. And I was like, no, we need to figure it out before we close. So, so it took literally a month.
So smart of you to say that, because I've seen so many situations where that doesn't happen, and then no one cares about figuring it out, right? They're never going to figure it out. Once the deal's closed, it's closed.
Yeah. Yeah. And it's, I think that would be the only advice for founders, and whether you're raising money or selling your company, it's like, whatever your post package looks like, make sure that gets addressed, because it's always the last thing, because you want to be a good founder and you want to put the deal first and make sure that the company is going to be supported. But you have to make sure that you're taking care of it at the same time. And it's always the last thing that gets done. And and sometimes it doesn't get done. So it's important that that's part of it.
Exactly. Yeah, I totally agree. And what was your setup afterwards in terms of, did you have holdbacks and escrow? I know you said you were there until just recently in May.
Yeah, so we had some really big decisions to make, both RJ and I, because we had never taken any capital out of the business, and we had been doing this for 20 years. When we started, we were in our mid-20s and had no responsibilities and no like real bills or anything. So, but fast forward, and now we have families and mortgages, and so it was a very different scenario. But yeah, so we decided they were trying to convince us to roll over some of our equity, and we had the beginnings of a plan of like what our roles were going to look like, and post close and all that. But in talking about it, it's just like, we've never taken anything out. Like, we should be compensated now for what we've built and what we're selling, and like separate what we're going to be doing in the future, and we should be compensated differently for that. So we both ultimately decided to take 100% of the proceeds out, because like that was our kind of reward for building and getting to this point. And then let's have a separate conversation of what is our role going to look like, and how should we be compensated for that. So we ended up kind of getting the best of both worlds, because we didn't have to roll anything, and then we still got packages to stay on and help with the transition and all of that. And so that ended up being a much better situation, because every founder that I know that has done earnouts and things where it never works out the way that you're hoping. It's always, rarely does it like work out more in your favor. I hear probably 9 times out of 10, it's not what they're expecting. So I didn't want to end up in that situation after 20 years. So that was like the best way for us to handle it kind of at the time.
Yeah. Yeah, I mean, I would agree with that. If you watch our episodes, it's about 1 in 10. It's perfectly happy with the entire outcome of the whole situation. But you learn a lot going through it. That's for sure.
Yeah, for sure.
Go ahead.
Yes, I think post close, it was very, very, and I'm glad that we did it the way we did it, because everything sounded great when we were going through the transaction and like what our roles were going to look like. And probably about 3 or 4 months into it, I started to realize that it wasn't really what I thought it was going to be. And so it was a good kind of time. It was good timing. I stayed on for 15 months, and it just got to a point where there's different philosophies in terms of how we ran the companies. And we were very focused on culture and innovation. And now that we were part of a much bigger organization, there was a much lesser emphasis on that. And the focus was more on numbers and EBITDA and the rule of 40 and like whatever we had to do to get there, versus, is the team happy? Are they motivated? Like, are we focused on the right things? And so it just was a different dynamic. And so I was happy to kind of transition out and help the company, get to their EBITDA targets faster. And that's ultimately why I left. And and they're in process, so they're going to sell at some point. And we'll get another bite at the apple, and then figure out what's next.
Yeah, that's exciting. And were most of your employees, I guess, all of your employees were rolled over in the transaction too, so they all became part of the buying company? Yep.
Yeah. So that was the other kind of interesting thing, because I think because of the way that we built our organization and our culture, we were very focused on talent. So we had fewer people, but they were well paid, but they were also really good. And where we saw the quickest impact was really on the engineering side. Was our team was viewed as expensive, and whereas a lot of their engineers were either in Canada or somewhere like offshore and weren't getting paid as much. And so we saw a lot of our kind of key engineering talent depart pretty quickly. And that's when the innovation started to slip a little bit. And so I would say maybe a quarter of our team is still there. It was a challenge, because I think one thing that we didn't really talk through was like how the two organizations were going to come together, and because we were the acquired company, they we were definitely looked at as we were going to report to somebody that was already there, regardless of who was more talented and had more experience. And so I think that's where things fell apart a little bit. And it was hard to kind of watch. And, I had a lot of conversations with people that we've worked together for a long time. But I just told everyone, like, this is kind of unfortunately the way it is. Like, they're the acquiring company. We have to fit into their structure, and you're either going to like it or not. And like, if it's not for you, it's not for you.
Yeah. I mean, I was just going to ask you, because having a transaction go so smoothly, like, what would you have done differently looking back? And there's not probably much, but that could be one of the things.
Yeah, it's not much. I think we were very fortunate because by holding out at the end of 2020, we did end up getting acquired for almost double what the original offer was, 12 months later. So I wouldn't have done anything differently leading up to the sale. Like, we probably could have waited another year, and we would have been even further along. But the timing really couldn't have been much better, because in January 2022, like, the markets were still good. Like, we were trading off multiple on revenue, not EBITDA. And those deals started to fall apart, mid 2022 and 2023. Like, you can't get those deals anymore. So even if we were bigger from a revenue standpoint, I don't think we would have gotten the deal that we got. So yeah, I really wouldn't have done anything differently. I feel pretty fortunate that the timing worked out the way it did. The only thing I maybe would have done differently would have spent more time during the process of how are these two things coming together? What does kind of the vision for the combined entity look like? Like, those were things that never really got looked at or discussed. And we were trying to discuss them in the year after the transaction. And it honestly never really got sorted out, and it still isn't sorted out. So
it rarely does.
Yeah.
That's the thing. And even if you do talk about it, sometimes it just still doesn't matter, right? You're going to face the reality when the two companies merge anyway, and they're going to do what they want to do. So
yeah. I mean, the good news is, like, the business, it's a great business. It's the 800-pound gorilla in the space. So I think collectively there's 1,000 clients, mostly teams and leagues, but they've got huge penetration on that side. They are in the early stages of getting a really good brand product. So I think it's a great business, and it can be really successful under the right leadership, for sure.
Yeah, absolutely. Well, any other final thoughts or advice you would give to, founders or investors, I guess, who are going through transactions? Yeah,
I think probably the last thing is, if you're working with a co-founder, make sure that you guys or multiple co-founders, make sure that you're aligned on kind of what your goals are post close. Fortunately, RJ and I, we've actually known each other since the 7th grade, and we grew up racing motocross together, and we've spent a ridiculous amount of time together, traveling as kids. And then we started the company, and we were living together and traveling together all the time. And so we had a really good bond, and we always complimented each other's strengths and things. But when it came to raising money and came to selling the company, we spent a lot of time together, making sure that we were aligned on kind of what we wanted out of everything. So when we did the big raise in 2017, it was all about culture. And we spent probably 2 or 3 weeks working on a culture deck that we knew we were going to scale the company from 20 to whatever number of employees. And we had made a lot of good hires in the past. We had made a lot of bad hires in the past. And we kind of looked at both sides and literally made a checklist of, like, the must-haves and the can't-haves and things like that, of, like, as we were hiring these people, how do we retain the culture when other people are doing kind of the recruiting and things like that. So so that was a big thing.
Super cool. You should share that deck. That's probably, if you still have it.
I do, yeah. I mean, it was used in every onboarding. So, like, every employee looked at, like, this is what we stand for and what we're trying to create, and the vision for the company and what we expect of our team. And so that was, like, kind of day one when people were starting with us. So that was a big thing that we did in 2017, because we wanted to retain the culture as we were growing. But when it came to the sale, it was more about, like, what do we both want out of this? because it's not going to be ours anymore. We're going to be employees. And so we had to get to a point where it's where we were okay with knowing that things were going to be happening that we may or may not be good with, and almost taking a step back where it's like, it's not ours, and we have to both be okay with that. And that's kind of the conversation we had, and we're just like, okay, let's do this.
Yeah. One last question for you, just thinking back about that first exit conversation you had. What was it, in like late 2020 or early 2021?
Yeah, late 2020.
Ultimately. Yeah. That you turned down, and it all worked out well. But how risky was that at the time?
It didn't feel risky. Like, it was almost, I remember when we were going through the process, and one of the parties that was putting an offer, and he's like, I know this is going to feel offensive. And like, when he started that, I was like, it's okay, don't worry about it. And I was like, okay, you can tell me, but like,
but yeah,
yeah. So I was like, yeah, I'm not offended, but
right.
No thanks.
Not happening. Yeah.
So
yeah. Well, I guess, I mean, you must have been in a good position at that point, even though things were obviously evolving materially. You know, you had the writing on the wall to know the direction you were going, and probably your cash flow you weren't in a desperate situation.
Yeah, we weren't desperate by any means. Like, we were definitely kind of funding, like the business was funding itself. It wasn't like we had a lot of capital in the bank, but we felt so strongly that the strategy was going to work. And because I was very involved in like the sales and the customer success side of things. And I just kind of knew, I basically showed up to like every sales meeting, and I was doing all the QBRs and the monthly reviews with our brand clients. And even though they weren't paying us, we were servicing them like they were our most important customer. So I had a finger on the pulse of every one of those deals that we had closed. And I had basically an 80 to 90% certainty that these were going to convert. And while these buyers were like, well, who's to say that the strategy is going to work? I just felt so strongly that it was going to work. And it was also kind of that perseverance to make sure it worked.
Yeah.
And the rest of the team.
It has to work.
Yeah. And the rest of the team felt it. And they would just work so hard to service these brand clients and be a strategic partner. And that we just kind of knew in our gut it was going to work. So we happily shut down the process in December of 2020 and just put our heads down to focus on the business. And literally 7 months later, we were back in process.
That's awesome. Well, congrats again. I mean, what a success story.
Thanks, Paige.
I'd love to hear the 2.0 version of this one day. But yeah, that's a wrap.